This is episode 212 of Zen and the Art of Real Estate Investing with my guest, Drew Breneman. Drew is the founder and CEO of Breneman Capital. He is also our second-time guest. You could find him before on episode 40, Creating a Blueprint for Real Estate Success. That was back in April of 2023. Drew, welcome back.
Yeah, thanks, Jonathan. Thanks for having me on. Appreciate it.
Yeah, it's always good to talk to you. And full disclosure for the viewers, I am invested in 2 syndications with Breneman Capital, and it all started with our previous podcast. So that's an interesting story, but getting you back on, I wanted to first go over the state of syndications right now, because the last time we have 172 episodes in between your last and now, which is kind of crazy to think of. But a lot's changed in the syndication world, and I've watched it from what you guys are doing. So what do you think has changed in the last couple of years that's relevant for the listeners to know?
Yeah, well, quite a few things. I think just just kind of what's going on in the real estate markets obviously changed a lot. Where you went from, if from 2020 to late 2022, the Sun Belt had just such a massive explosion in rent growth, population growth, job growth, and prices and investors followed all that. And so you were, at that point, everyone, including myself, they were looking at the Sun Belt going, what should our next deal be? What can we do? And where all this rapid growth is. And, all that, around the time we recorded our episode was basically shut off like a light switch in those markets where there's still a lot of population and job growth in all those, Sun Belt cities. But what happened is just a lot of new apartment supply, and just talking about apartments only, because that's all I invest in.
It's interesting, though, how it's changed. How has it changed your guys' overlook when you're looking at markets and new deals coming in?
And so, yeah, since I was on last week, we bought 4 deals total, and then 3 of them were just completely off market. And then with 2 of them being just from a group we already bought property from before, and then which was one of the ones you invested in. And then the other one that was not in the market, we just bought through like a management company relationship where they introduced us to the owner on the one in Madison. And so, it's been, the main thing we did though around the time where I was on last was just really looking at the numbers and going, okay, what makes sense? And this is still going on, where from a valuation standpoint, you have all of the most exciting markets, let's say in the Sun Belt, your Phoenix, Dallas, Austin, Nashville, all of Florida. Those trade at lower cap rates, and so do the coastal markets than the Midwest. But right now, the highest rent growth in the country is all in the Midwest. Highest rent growth, highest occupancy. Just going back to the whole supply and demand thing, where the demand isn't as strong, in let's say Chicago as it would be in Dallas, but they're building, a tiny fraction of the same amount of new units. In Chicago right now, there's only 2 buildings over 50 units under construction in the entire city.
Wow.
And the reason is, interest rates, construction costs, but also they enacted a 20% affordable housing requirement. So if you're going to build a new property, a new multifamily deal, 20% of the units need to be at affordable rents, which is, for rounded numbers, this is not how it's calculated. It's a third to half the normal rental amount. So then that makes your deal not financially feasible.
Right.
So you have, all these neighborhoods in Chicago on the north side that are growing still very rapidly. I think it's a common misconception that, like, obviously Illinois, the population is not growing, and but within it is having some population loss in some parts, but other parts are growing fast. Like the north side of Chicago, those neighborhoods in downtown, that grew at a similar rate to Denver from 2010 to 2020. So, and no one thinks Denver is not growing. And so you have the growth like Denver, but no supply. And then and so we looked at that. And then also, like I had mentioned before, I'm from Milwaukee, and then I also went to college in Madison. And those markets are also at the top of the charts for rent growth, high occupancy. Madison right now, as we said, is number 2 for highest occupancy in the country, number 4 for trailing 1-year rent growth, number 6 for lease new supply across all markets. And then Chicago is basically at the top of every list when it's for just the big markets, the largest markets. So we saw that and go, okay, you have the best fundamentals right now. and you have higher cap rates there than all these other markets. And so we just went, let's just go back to what we were doing, and from, basically 2005 to, 2021, when we finally started looking at the Sun Belt, we just said, all right, let's just focus back on the Midwest and just do what we've always been doing. Um, and it's gone really well. I know everybody, the deal you invested in has been really happy with it. Anybody who's buying multifamily that's 5 units on up, the best, cost of capital is going to be Freddie and Fannie.
Yeah.
And they have 2 different programs you can use at each one: a small balance program for loans that are under 5 million or 7.5 million, depending on the market, and then their conventional programs for over those amounts. And yeah, like the loan I had on that for at 5.5%, like we got preferred pricing because we've done so many loans.
Yeah.
But that discount was maybe 20 basis points, so 0.2%. And then we did a rate buy down, so we paid 2 points to have the rate lowered. But so that we were getting a better rate, but if someone else still could qualify for that loan, but maybe it had the, preferred status, so to speak, their rate still would have been in the fives. Like it would have. So it's just really more speaks to, like, this is one of the reasons why I like these kind of deals. The agencies get aggressive on them. It's 100% occupied building. They love to
Yeah.
lend on it. And then, whereas if you're buying a value add rehab deal, you're going to a debt fund. It's, SOFR plus a spread. You're all in today, including your interest rate cap. You're paying like 8% interest a year. And then, by the way, the deal unlevered makes way less than 8, so you're negative leverage the whole time.
Yeah.
So yeah, that's why focusing on the debt, I think, is smart. And for us, like, yeah, we only, buy deals that are positive leverage day one, meaning that, your cap rate you're buying it is higher than the interest rate you're borrowing at. So you'd have positive cash flow.
What do you think's coming in the next 2 years, and how are you adjusting what you guys want to do, as a company that's looking to acquire multifamily in an odd market that we all hope is going to level out at some point, but hopefully level out, in your favor for better deals?
Yeah, and I think, really, for what we're looking for, it's very simple. Where we're trying to find, like I was saying, these deals that cash flow day one and then have some rental upside.
Yeah.
And so, like, I'm just laser focused on that, and I'm not really spending a lot of time, prognosticating what's going to happen. I'm happy to answer the question though, but in
Yeah. Yeah.
terms of, like, for our strategy, it doesn't. It almost, in a way, it will matter. Obviously, if the market starts ripping up, our deals will do better. But the way we underwrote these deals was just almost as if nothing changes. We raise the rents to what they should be today, and then rents grow 2.5 to 3% a
Yeah.
year, as well as expenses from there. And then that's it. And then we sell it at, a reasonable cap rate, and there's not really anything changes. I think, for the main thing that I've been surprised with, I'd say, is a lot, some of, like, the other sponsors that are doing a lot of these Sunbelt deals. A lot of them, nothing's changed. They're still doing the same floating rate debt, value add,
Yeah.
aggressive deals. And, I did one of those. I saw how difficult it is, and how much risk was involved, where you have no real cash flow while you're renovating, and you're trying to get it to a certain point
Yeah.
in a market that ended up being declining. So those deals are, to me, extremely risky. And, I sort of almost don't understand, like, why make that bet anymore, so to speak, when you could just buy something nice, hold it for 10 years, cash flows already, make it cash flow more. And I know this is very oversimplified, and you can lose money in deals, but it's like, you look at that. Let's say we'll buy something that cash flows today on low rents. We're going to own it for 10 years. It's just really hard to lose money on that.
Yeah.
And then, when the market does start going up more rapidly, you'll still benefit from that. So you really don't need to worry about, with our strategy, like, timing the market at all or anything. But to answer your question, I guess I think that the odd part about the market now is most everyone is holding on to their deals. All deals are still trading at neutral or negative leverage in all the markets. And so they're not attractive when you look at, like, okay, this is where this sold. And it'd be like, wow, that'd be like, you got to put 40% down and you'll have 3% cash on cash starting out. Like,
Right.
that is probably right now your average apartment deal. That is literally the metric for a stabilized apartment building.
Yeah.
So then it's just, you look at that and go, that doesn't feel like this distressed market where there's deals everywhere. And I don't know if we ever will get to that point, because a lot of the, so many people, I know there's a lot of talk about floating rate debt and all this stuff and short-term loans, but most all the lending is still done by these agency lenders, 5-10 year fixed rate money.
Yeah.
So multifamily, there's just the way the debt is set up, there's going to be, I think, less distress than people think. The distress that will be there, it'll be all on the value add, floating rate,
Yeah.
3-year bridge loans, where the ownership group doesn't want to add the necessary money to keep the deal going.